Hi and welcome to this week's video where as usual we'll take a look at some earnings trading, some options positions around upcoming earnings. As you know, we like trading earnings because of the edge that actually analyzing the data allows us to have. So it is sort of a statistical approach, these earning strategies, where we pretty much play the numbers a lot for these what we call volatility strategies. So if you're not quite familiar with these and would like to dive into more details, feel free to check our resources here, our wiki, where you can browse tutorials and different things to get more familiar. In a nutshell, these are strategies that play around the implied volatility and the expected moves on earnings rather than just a direction, whether it's up or down. This is around the amplitude. And so, again, it allows this availability of the data and the statistical analysis basically allows us to know what we're getting into and so calibrate positions with sort of controlled risk rewards, controlled likelihood, and so calibrate a strategy and refine a strategy that we're actually comfortable with more than the actual, if you like, betting on an earnings reaction in itself. This is really more a numbers game. So here let's actually start by reviewing some positions that were followed on our Earnings Watcher platform, where we can actually compose, as we'll see in a minute, any position and so follow its real-time price. This is an example of sort of a conservative approach playing earnings, meaning that, again, as we mentioned, that this data analysis allows us to calibrate and know what we're getting into. Well, we chose to, for example, follow a conservative approach where we would like, these long volatility positions on the last week's earnings with sort of a low max loss. So we, as you see here, these are what we call inverse condors, where we have a long straddle, so a call and a put at the money, like the D-Dog here example, data dog. So a long call and a put at 145, which was the stock price when this was entered, or around it at least. But also we go ahead and we sell here also, and so a call and a put, but out of the money, so the 146 and the 144. So it is what we call why we call this more conservative, because as you see, the fact that we sold the strangle, so these short call and puts, basically lowers our exposure, where a classic straddle, just the long call and put by itself, will sort of have a bigger risk but also a bigger reward. Here we're more concerned of reducing our loss. And so last week we chose these three positions that you see on Reddit, Coin, and the Dog, three inverse butterflies. And so you see here a classic outcome of this type of trading where, again, we wanted positions with low risk, and so low maximum risk, around 20 or 30% perhaps. And so you see that, for example, this is what happened for the Reddit position, where the stock did move a lot, but not enough for our break even in our position. But as you see, we're sort of fine with that. The loss here, and again, this is not really optimizing the exit, etc. Sort of just going with the basic calibration, where the expected loss 21% that we gladly take. Another position that came close, but again, sort of pretty much broke even. This coin position, where there was a substantial move higher than the case for Reddit, but still not enough to be profitable. But no problem, because sort of we took back our money, entered for L for 12, exited for 11.81. But again, what we like is sort of the, and this is why it's a statistical game with this controlled loss. If it basically goes our way, it will compensate for these losses, especially these controlled losses. And so this was the case for a D-Dog, where there was a substantial move, and so we were able to pretty much have a bigger return here to 100%. But given that we started with sort of a low capital, just $65 basically for this whole position. position. And so you see here how basically taking these positions with a controlled access can allow us to, week after week, play the numbers edge. And so this week, let's go ahead and sort of do this type of analysis for an example, again, using the numbers. So using here our home screen where we have this full calendar for the upcoming weeks. So let's filter for the full upcoming week and keep only liquid options that are easy to trade, sort of. So here we have the upcoming earnings with sort of the key numbers that we'd like to look at, obviously. So some information about the past behavior here, the average move, the standard deviation, the last move. We're pretty interested in these as they tell us sort of a first path into how volatile these stocks are. Here we're interested in, like the example we showed in our watch list, long volatility again. So betting on volatile stocks that have a high likelihood of beating their implied. And so obviously it's interesting for us to compare this average move. The standard deviation, by the way, is a measure of dispersion, basically how wide, how the range of moves, basically how wide the range of moves and how big these moves that historically happened, and pretty much compare that to the implied move. As you know, this is the priced in move. This is the straddle, closest expiration straddle break even, and this is pretty much the basis of the setup that we like to compose. So let's go ahead and, for example, sort by the highest standard deviation, meaning here stocks that have the highest range of moves, not only a high average move, but also a very wide distribution. And so you see that we have some candidates this week for Unity, CVNA, Rivian, New, where the average move quite high standard deviation, and somehow an implied move that's well priced in. For example, in the case of CVNA here, an implied move of 14 versus an average of 16. So a bit undervalued, not so much, but sort of a good setup for us. And so this can be one of the candidates that we consider from for our strategy. By the way, we can also go ahead, scroll down here and sort of have this selection curated by us by sorting and following the numbers for each strategies for the 2 upcoming weeks. So you can also research those stocks from there. Let's go ahead and do an example for CVNA. So a first step to analyze our position or our how we would like to play this long volatility is, obviously, as we discussed, we'd like to know more about the past moves. So here we open our moves analyzer where we have this precise breakdown of past moves. We start by the moves that happened on the last quarters, and so notice how the blue color rows are basically where the moves on the day of release, so the first trading day after the release is done. This is where the action happens. The more highlighted, the blue, the bigger is the move compared to the average move, right? And so you see here a lot of blue, and obviously very big moves for CVNA. This is a very volatile stock that, as you can see here, have a very high volatility score computed at 88%. Not always the case for all stocks, obviously, but an interesting example, and this is a good type of candidate that we like for these long volatility. You see that, for example, the minimum move that happened in the last sort of 2 or 3 years is this 8% earlier last year. So this can be considered as sort of our worst case scenario, that the move would be just at this amplitude. We can scroll down and here get more and more insights about the different, these moves. We see the average, the standard deviation, and so this high range of moves that we see going from 45 to plus 45, as we've seen in the previous table. And especially another number that we like is these amplitudes of when it beats the implied or not. So it's good for us to know that here, as you see, when it does beat the implied move, historically, it beats it on average by an amplitude of 13.7%. On the other hand, when it doesn't beat that implied, it sort of misses it or does not exceed it by just 7.2. this is a good signal for us because we see that this amount, the 13, is pretty much double of the 7, and it means that even when it misses basically or does not beat the expected move, it does not miss it by a lot. While when it does exceed it, it exceeds it by pretty much a lot and double what it misses it by on average. So these are the type of stats that we like to keep in mind when we prepare for these strategies. And for example, also we can get an idea of the average upward move or downward move. This can help us prepare our exit, basically to get an idea of, okay, what is a realistic range of moves. Here, from what we see, a rough range is sort of this average of 16, a minimum that we've seen historically in the last years of 8%, and sort of a maximum that can go to 48, but let's sort of assume a realistic sort of even perhaps 25%, as you see in these quantiles, meaning that sort of 80% of the moves were under this 25, so it gives us a good threshold. So now with these numbers in mind, we can go ahead and now compose different positions for our strategy. And so here we go to our simulator, which is basically an option pricing simulator that takes into account the famous IV crush, so the IV effect that is responsible for these high implied moves, by the way, on earnings. And so it's very important for us to model this behavior where IV drops on the first day of trading. This simulator basically allows for that. And for example, let's go ahead and compose a classic here. As we click on classic strategies, we can compose a classic straddle. So as you see here, the long 290 call, 290 put for the closest expiration, given that the stock price is around 285. So perhaps we can go with the 280 put, not the 290, and so have sort of a more delta neutral position. So here we deselect and select the 280, hit run again. We, as we scroll down, so we get an idea, more precise idea of our break even here, as we've seen in the implied move range, expected to be in the 14%. But especially, we're interested in these risk rewards again, and here a classic example of how studying those numbers help us really calibrate our risk reward. And so we see that the worst case scenario loss if the stock does not move at all, which we have seen to be sort of unlikely, a 0% move. Well, it will be an 84% loss. Okay, so if we take this type of position, we need to be prepared for this very worst case scenario, even though, again, it does not really happen. We sort of saw that a realistic minimum move is around that 8%. Let's go ahead and simulate it using the sliders. And so we see that, okay, a more realistic loss is this 44%. So getting into the trade with these, when we study these past moves, etc., this is what we sort of are exposed to. And then on the other side, let's simulate that 25% move, for example, that we've seen being sort of a realistic big move over the last years. Well, we are looking at sort of a 97%, 100% return. And so directly here we see our risk reward, sort of a 2-to-1, 50% or 40% loss for a 97% return. Again, this is a concrete example of how studying these numbers really help us basically find the position with which we're comfortable with and know what we're getting into. As we scroll down, we have other statistics, especially comparing this break even to the histogram of moves, the range of moves, and you see that we have an overall score of 57. Perhaps not the highest, but given how volatile the stock is, we are sort of happy with this break even, and we see the fat tail of moves that happen outside of our range, with many moves in the 20 to 25. So below we find this risk reward analysis that we did, sort of already done automatically for us using the reference past moves numbers. And so again, this is a position with a good likelihood, a good risk reward, 2-to-1, but with a maximum loss that can be quite extensive, this 97% or 40% in that 8% move scenario. Now, as we mentioned in the beginning of the video, we like here to simulate sort of a more conservative approach. And so a more conservative would be to transform our position into what we call inverse condors. Let's perhaps browse the inverse butterfly list that is automatically set up for more centered positions. And so, for example, we find here the 290, but selling the 340 call and the 260 put. Directly we see that the max loss for that 0% is reduced already. For this is because we are selling, as we noted in the beginning, these out of the money legs. And if we simulate that realistic move of 8%, we see that, okay, we reduced basically our loss to 21 rather than 24, rather than that 40% that we have seen for the pure straddle. So this is an example of, okay, we can, if we're not comfortable with that big loss, perhaps a position like this, more conservative position, with still a great likelihood, even higher, since we lowered our break even by composing this inverse butterfly, and the risk reward is still pretty much worth it, where realistically this is a 24% loss, and if we simulate that 25% move, we're still exposed to here a great return of 78. And so what we can do is follow this position. This allows us to find it in our watch list, and as we've done for the last week's position, we can go ahead and follow it, and this allows us to really practice pretty much our strategies and get comfortable. Thank you for watching. Hope this was helpful. Feel free to reach out if you have any question, and see you in the next video.